everyone to our third Future of Financial Information webinar. So it's really becoming a series now, and it's my pleasure to welcome Byoung-Hyoun Hwang from Cornell University. Byoung, please, you have 30 minutes.
Cool. Let me share my screen. Oops, no, wait. Here. Yep, thank you so much for, I know this is a super hectic time, so thanks so much for taking the time and tuning in. So it's a paper about like social interactions, social finance, if you will. And this is joint work with Hwang, who is in information systems at Hong Kong University. Okay. So I guess this is kind of the big picture. As we've always relied on each other for the latest news, for any recommendations, that's always been there. I think what's become a little bit different is that much of this now happens online. We can ask each other online about recommendations, where to spend our next vacation, what doctor to go to, and so forth. This also seems to be playing a role in financial markets, right? So there's hints that word of mouth is also important in finance among analysts, investors, managers. But I would argue that still we know relatively little about social interactions in finance. Right? There's a huge literature trying to see how people react to public information, but how information disseminates privately among investors, we still know relatively little. And I think this actually has the potential to be very important, like studying this. And so I'm going to borrow a little bit from David Hirschleifer's presidential address. When you look a little bit at the evolution of finance, we started out with this traditional framework. People form rational expectations, and then they have expected utility preferences. And then it depends a little bit what side you're on. I think there are some people saying that, well, these models are elegant, but they're having a hard time capturing what we actually see in the real world. Right? So along came behavioral finance, which said, well, let's create models that are based on assumptions that are a little bit more realistic of how people actually behave. Okay? And again, depends who you talk to, but I think a lot of people would say this has actually been a very helpful exercise. Now, when you look at behavioral finance, the way these models are being made more realistic is by accounting for some of the many biases we seem to exhibit, like extrapolation, prospect theory, preferences. Right? These are all biases at the individual person level, right? But we don't operate in a vacuum. We're constantly talking to each other. Right? So it seems plausible that there's biases not at the individual, just at the individual person level, but also in the way we talk to each other. Right? So one example that Hahn, Hirschleifer, and Walden present is that when we talk to each other, like we don't share what's representative of what's inside our heads. We sometimes distort information, and sometimes we don't share all we know and feel. We only share a select subset, and that can cause actually listeners to misperceive reality. So one example they have is an investor is more likely to talk about investment successes than investment failures, even if an investor has had more failures than successes. Right? The investor just doesn't want to look stupid. Right? So it just talks about successes to the degree that listeners don't discount for that. All they hear is these success stories. They might believe that outperforming the market is easy and flock to active investment strategies. Right? So these are just some of the biases that might be going on that could actually be really important in helping to explain how people behave and ultimately what moves asset prices. Okay. So beyond, I think, this pretty reasonable notion that we're more likely to talk about successes of failures, we still actually don't, we still know relatively little about these social transmission biases. Like, is it actually true that we only share a select subset of what's inside our head? And if so, like, what content are we more biased towards or against, and what are the effects? And so this is kind of what we're trying to study in this paper, like of what's in our head, what subsets do we actually share with our peers, and why. Now, it's kind of a difficult question to test empirically, actually, right? So because you would first need to know what kind of information is in people's heads, then what subset do they share, and that information that they're sharing, is it useful or is it just garbage, right? Not even the NSA has that kind of data. So it's actually a little bit tricky to study. So the way we think we can do this is that, given that more and more of our information collection and sharing is happening online, like, for better or worse, we can actually increasingly track what people think and share through the digital footprints they leave behind. So in our particular setting, we look at this website called Seeking Alpha. To those of you not familiar with this website, it's a website where anybody can just craft a stock pitch and load it up. It gets first reviewed by an editorial board. If they think it's of adequate quality, they publish it on the website. And then, among others, you get paid by page views. So this is a website that attracts more than 15 million unique visitors a month. That's more than CNBC or weather.com, which I think it's insane. Like, I check weather.com like 3-4 times a day. Maybe that's because I live in Ithaca. So it's a really popular website. So this is how it would look like for when you actually enter the website. So you can just scroll, like, which articles do I want to look at based on the title, the author, and the stock it talks about. So we have aggregate server log data. We know how often actually each of these articles were viewed in between August 2012 and March 2013. Once you click on the article, you can then decide whether to quit or read all the way to the bottom. So the articles tend to be rather long. Right? So we also have data on how often a user actually scrolled all the way to the bottom of the article. And we're going to call that read to end or read to end. And at the very end, you can then decide whether to share the article with a friend. And so we also have data on how often an article is actually shared via email. So we got these 3 dependent variables. The first 2, page views and read to ends, tell us something about people's own personal consumption of articles. And the third one is tells us something about sharing with the outside world. Okay. So we want to see what types of articles are investors more likely to consume on their own, and what types of articles are actually more likely to share. Now, in terms of categorizing articles, so we've read quite a few at this point. It seems to us that the 2 most salient attributes along which these articles differ is sentiment and reliance on numbers. Like, sentiment is pretty straightforward. Some articles are pretty bullish, others are a little bit more bearish. Now, we had this conjecture that, in terms of what types of articles are you more likely to consume on your own, there's a large literature of psychology that we're more drawn to negative information. When we see a negative article, it just grabs our attention more, we're more likely to read it. So we actually thought, even before looking at the data, the more negative articles are perhaps more likely to be viewed and read to end. In terms of sharing, though, it's admittedly a little bit loose, that conjecture, but there too, when you look a little bit at the social psychology literature, like, you don't want to be the person constantly spreading negative thoughts, like constantly telling your friends about the latest rumors that we're not going to get summer for the next 3-5 years. You don't want to be that person, like this negative person, or you're going to stop getting invited over for dinner. Okay. And there's some evidence on that, like experimental evidence, right? So our conjecture was that while you're more likely to consume negative articles, in terms of the articles that you forward, maybe more the positive ones. So not the ones that predict an imminent market crash, but more upside potential. This is kind of a derivative of sentiment. Some articles are bold, right, in the sense that the sentiment in the article is actually very different from the consensus sentiment. Okay. And so, and that could be, the boldness could be either way, either extremely more negative or extremely more positive. And so we were thinking bolder, more unique content is likely to get us a little bit more curious. In terms of sharing, we didn't know, we actually don't know. We thought on one hand, sharing unique perspectives might make you look a little bit more interesting. And on the other hand, at least in financial markets, right? So if everybody says Tesla is overpriced and you find this one article saying that Tesla is underpriced and you share it to your friend and Tesla subsequently crashes, you look pretty stupid. Right? So maybe in financial markets, being wrong together is not as bad as being wrong alone. And so there's some literature on analysts, Hwang, Kubik, and Solomon. They actually find some evidence along this line. But yeah, this is just. And then the last one is, so when you look at some of these articles, I mean, all of them ultimately contain numbers because these are stock pitches, but you see a little bit of spread. Like there's some articles, just give you an example, they go really deep into the financial statements. Like these are 2 articles that recommend Berkshire Hathaway to be bought, right? But you can see the left article, it just goes really, really deep into the financials. Like it just talks about all this accounting stuff. And then there's others that focus more on softer aspects of the firm, like quality of management, quality of the board. And there's some numbers here, but they're merely there to show that incentives are aligned for managers. So we're thinking that, like, if you had to read either the one on the left or the right, our conjecture would be, well, the one on the left is kind of a pain to read. So people are less likely to read these articles. And there's some experimental evidence supporting that notion. Okay. In terms of sharing, though, there's some thought that opinions couched in numbers are often viewed as more thoughtful, more convincing, more credible. Like the source of such opinions is thought of as being more thorough, intelligent. I just think of this common bias we have when we hear this person majored in nuclear engineering versus that person majored in sociology, and the inferences we sometimes draw. Okay. So we think maybe in terms of sharing, maybe you're more likely to actually share the quantitative content. And so we're going to take these to the data. I'm sure there's many more attributes you could look at, but we just thought we start with those 2, like sentiment and reliance on numbers, because those are just so salient. We just have a bunch of other variables there, control variables. So maybe I'll just go quickly into the results. Again, so from a reader's perspective, you have 3 decisions to make. Like, do I view an article, yes or no? And then do I finish reading an article, yes or no? And then do I share the article, yes or no? Right, so we have these 3 regression equations which kind of mimic the path a typical reader would take. And we first try to predict what features make it more likely that an article is viewed and read, and what features make it more likely that an article is actually shared. For regression equations 2 and 3, we either just do this regression equation, or we also do, we control for page view in regression equation 2. We control for read to end in regression equation 3. Like our interpretation is that if you control for page view, the question is, given that you viewed an article, like conditional on you viewing an article, what feature makes it more likely that you read the article to the end? And if you don't control for page view, it's a little bit more, like I'm speaking loosely here, unconditionally, what features make it more likely that the article is read to end? All right, so let's jump straight into the results. So the first thing we find is that it's consistent with our prediction. And I wish this had been a registered report. We really had these predictions before looking at the data. So you see that if the title is more negative or the text in the article is more negative, those articles are less likely to be viewed and read to end. Right? So more negative. Sorry, this is sentiment. So more negative, more likely to be read to end and more likely to be viewed. Right? So the sentiment is fraction of positive minus fraction of negative words. Right? So you make it more positive, it's less likely to be viewed. Or you could just say more negative, it's more likely to be viewed. Bolder articles are more likely to be viewed and read to end. And in line with expectations, if there's tons of numbers in there, it's less likely to be viewed. Okay. We also look a little bit about, like, if the article is on a stock with certain features, So we find that if this is articles on a stock that resides in either a lot of long legs or a lot of short legs, those articles also are more likely to be viewed. So these results kind of tell you how investors behave by themselves. Let's look at how investors behave in a group and interact with each other. So this is kind of the results on sharing. So here you see the exact opposite. Right? So in the previous slide, you saw that more negative articles are more likely to be viewed. Now you see more positive articles are actually more likely to be shared. Okay. If it's less bold, it's more frequently shared. Okay. And it's the quantitative articles that get shared more. So it's actually the exact opposite of what we had in the previous slide. For the stocks, you see people enjoy talking about stocks that reside in the short leg. Long leg stocks, I guess people find them boring. People don't like to talk much about them. Like, even though in their own time, they actually read a lot of articles on stocks residing in the long leg, but they just don't make good conversation pieces. It's a little bit consistent with this notion that the reason stocks reside in the long leg is because they're boring. Right? So people don't want to talk about them. So maybe they become overlooked and underpriced. Right? So when you look a little bit at this kind of a summary of the results thus far, in terms of the articles that I personally am more likely to read, it's the more negative, bolder, less quantitative articles. Okay? What articles am I more likely to share with my peers? It's the more positive, less bold, and more quantitative stocks. Right, so the articles that we consume and the articles that we tend to share are actually very, very different, which we suspected a little bit something along the lines, but we're still a little bit surprised by that. Okay. I think, yeah, I think we don't know of another study that actually documents the systematic bias between what we consume and what we share. Now, there's two interpretations to this. Like, the reason I'm more likely to share these positive, more quantitative articles could be because I care about you. The reason I share these articles with you is because after reading all these other articles, I know these are the most useful to you. That's why I'm sharing them. The alternative perspective is that, and this goes back a little bit to what the social psychology literature is arguing, is that a big reason we talk to each other and share stuff with each other is actually not so much to help each other, it's more about ourselves. So the reason I talk to you is primarily to make myself look and feel better. Right? So impression management and emotion regulation is what this literature calls it. Right? So the reason I'm sharing these more quantitative articles, more positive articles, is because I'm managing my impression. Right? So I don't care directly about you. I just want to make myself look and feel better. Right? I just want what's best for you, me. Like a little bit something along those lines. This is another way of illustrating this. So the stuff that you find really interesting, you keep to yourself. The stuff you share is rather boring, but you do it because you want to manage your impressions. Right? So these two have very different implications of like whether this kind of sharing preferences is good or potentially really harmful. So the way we try to tackle this is, so there's some prior literature providing evidence that these seeking alpha articles are useful on average, in the sense that the sentiment in these articles actually correctly predicts future abnormal returns. So if this is a positive article, the stock in that article tends to outperform. If it's a really negative article, the stock in that article tends to underperform. Okay. So what we want to check is whether the articles that are more frequently read to end are actually more useful, they more accurately predict future stock returns, or whether it's the articles that are more frequently shared that more correctly predict returns. Okay. And so first thing, so we do find in our sample, there's some limited predictability of sentiment to future returns over the next 1 month, 3 months, 6 months. You can see the statistical significance is a little weak. Might be because we just have 8 months of data. a little bit more relevant for our particular settings. So you find that the articles that receive a lot of read to ends, right? Those articles, the sentiment of the article much more accurately, correctly predicts future returns. Versus you look at the interaction of sentiment with a number of shares, right? The articles that are actually shared a lot, right, they incorrectly predict future returns. So I think one interpretation you can attach to this is that individuals keep the more useful content to themselves. Right? So I'm sharing these positive, more quantitative articles with you, not because these are actually the more useful articles, right? They're actually less useful. I'm just doing that to manage my impressions. Selfish. Yeah. Do you want to, should we do now like a quick break for questions, or should I actually only have 5 more minutes. As I can just also plow through whatever you think is best.
No, I mean, maybe we can stop for a moment.
Sure.
I think
yeah.
These questions are quite interesting. So one is relating to the maybe identification mechanism, and specifically, how do you control for the fact that a user is unlikely to share an article that they haven't read in the first place, and whether you would actually need an instrument to properly identify the factors that drive the likelihood of sharing?
No, it's not just unlikely, it's impossible to share an article that you haven't read, just the way we define read to end. So you can only share an article if you scroll all the way to the bottom of the article. Okay. I guess I don't know whether that's a problem per se, right? Because we have these kind of, at first we just say, first step, like what makes it more likely that you read it? Then what makes it more likely that you read all the way to the end? And then what makes it in that third stage, within that subset, which ones are you more likely to share? In that sense, yeah, I guess I don't know. Well, I guess it's just very descriptive in a way, these results, right? So I don't see a problem per se, but I might be misinterpreting.
Okay, but then maybe we can come back to that in the the Q&A live. And in the meantime, the other question was whether you control for market and firm-specific performance in your regressions, given that there is some evidence that investor attention flows with.
Yeah, we do that in one of our tables. We control for past return, volatility, turnover, those things. I mean, we have 2 specifications. One, we just include in how many long legs and short legs do you reside, right? And so I should have said that. So long legs is, so we look at 172. Apparently, there's 172 anomalies at this point. Right, so we look at how many of those 172 anomalies do you reside in the long leg versus the short leg. So theoretically, the variable can range from 0 to 172. Okay. And so because all these anomalies capture all possible firm characteristics that I can at least think of, in our first regression, we just have long leg and short leg as a control. And then we try a regression where we just kick out long leg and short leg and just put in firm characteristics. But it doesn't really change the estimates on our main variables. It doesn't change the inference that you have this seeming bias towards sharing positive content and towards sharing more quantitative content. That doesn't get changed by those controls.
Okay, and there's one just coming in that you mentioned low power because you only have 8 months of data.
Yeah.
Table 4. If you use the fitted value for read to end and shared based on your model in table 3, would you find similar results for the asset pricing tests?
Based on fitted values. So I see. So to expand the that's an interesting thought. Yeah, we haven't done that. We just looked at the 8 months of actual data we have. Now we could try to extrapolate a little bit and lengthen the sample period by saying these are the types of articles or stocks that receive more shares versus read to ends, and then see. We could do that. I guess there's a trade-off then. You have more observations, but then you introduce another source of noise in the sense that you have to estimate now these are the types of articles that are probably more likely to get read to ends versus shares. It's an interesting thought. We haven't looked at that yet.
Okay, so I hope you haven't lost track of your own slides yet.
Okay, no, thanks for we can do more because I'm almost done. One thing we wanted to see a little bit is that like what are possible asset pricing implications, which again is a little bit ambitious because we only have 8 months of data, but here's our attempt. Here's our hypothesis in pictures. So imagine I get a stock article from like either Mikhail or Diego about a stock. Okay. I think it's more likely to actually cause a buy decision than a short position. Like part of it is this Barber and Odian paper that anytime your attention is drawn to a stock, you're more likely to buy than short. And then also keep in mind in our setting, people are more likely to share positive articles. Right, so when I hear an article through a friend about an article about a stock through a friend, it's more likely to trigger a buy. Okay. On top of that, we provide evidence that the articles shared more frequently generally lack investment value. Okay. So we think sharing virality can actually cause a lot of uninformed buying, which that might cause overpricing, which then subsequently reverts. Right? So we thought, let's test this. We do something very similar to like momentum, Jagadish Titman. So each day for each stock, we compute how often were articles about the stock in question shared versus viewed, okay, or shared versus read to end. Okay. So we scale, that actually relates to the very first question that was asked, like in terms of there's many ways a stock could get attention. Sharing is one, but there could be other unrelated sources. So we scale by page view and read to end to kind of, in a way, filter out any effects that comes from increased investor attention unrelated to sharing. And then we sort all stocks, and so the stocks with the lowest virality scores, we're going to call them low virality, and the stocks with the highest virality score, we're going to call them high virality. And then we're just going to see how these stocks perform over the next 1 week and over weeks 2 and 4. And so we have data a little bit on when actually these articles were viewed. And so 90% of the articles are viewed or read to end in the first week of article publication. Right, so our thinking is that if there's any virality inducing overpricing, it should happen in the first week, because that's when basically all these articles are viewed. Okay. Right, so we want to see over week 1, is there some overpricing? And then does it correct over weeks 2 through 4? And we've experimented with alternate windows over which overpricing might correct. The results don't change much. And so here's our table. It's a lot of numbers here. So let me just focus your attention on a couple of these. Okay, so these are stocks with high virality, and these are their DGTW adjusted returns in week 1, like in the first week of article publication. And you can see it doesn't matter how you define virality. In the first week, these stocks just go up. They do pretty well. And over the ensuing weeks, through 2 through 4, that kind of goes back down. Okay. You can also look at the performance of high virality stocks relative to low virality stocks, as opposed to just looking at high virality stocks by themselves. And you see a similar pattern. Right? In the week of article publication, prices go up, they then subsequently revert. And it's at least consistent with this notion that virality can create temporary overpricing. We have another table 6 where we then look at stocks that are likely to be short sale constrained. And you see that this pattern is much stronger, at least economically, in that subset. Right, so there's a lot of evidence, of course, that social interactions can be helpful. We learn a lot from each other. But in our setting, we also point to potential dangers. Right? And so if you just, this is basically what you want to take away from this paper in pictures. So the key finding is that what we like to consume and then what we end up sharing with our friends is sometimes very, very different. Okay? And the things that we share with our friends is actually not necessarily the most useful information, quite the opposite. Right? So that's consistent with, we talk a lot with our friends because it's more about us. We manage our impressions, we regulate our emotions. Okay? And so to the degree that your counterpart, the listener, doesn't fully discount for that, it could actually make that person worse off. Lead that person to make worse investment decisions, and it could even cause temporary price dislocations in the market. That's it. And that's Cornell. This is like 9 months of the year, it looks like this, and 3 months of the year, it looks like that.
Wow. Well, personally, I would find both versions attractive. But that's just me, maybe.
Yeah, you just need to learn how to ski, then it's fine.
There you go.
Yeah.
But yeah, thank you very much for the interesting talk.
Do I stop sharing my screen now? Yeah, right.
You can do that, or otherwise, you know what? Yeah, fair enough.
Yeah.
There's a couple of questions that we can maybe take off before turning over to Diego. So there's one: will the sentiment effects be stronger for stocks held by more retail investors? What would you think about that?
Probably. We should look at that actually, because I mean at least in our sample period, which is earlier, right, 2012, I think most readers of Seeking Alpha were retail investors. I do also want to emphasize though that this overpricing that we showed, like, it's implausible that this was generated by Seeking Alpha readers themselves. Like, they're just too small. Like, what we're thinking more is that it provides a representative snapshot of what the remaining investors think. So if there's a stock that's really viral and hot on Seeking Alpha, our thinking is that there's a chance that it's also viral and hot, like in other investor conversations. Right? It's just a representative snapshot of how investors think at a given point in time. Having said that, you could say that maybe that's true, but it's still true also that Seeking Alpha provides an even more cleaner snapshot of what retail investors think as opposed to institutional investors. So we should look at that. We haven't.
Okay. And the other question at this point was, does the website use a certain algorithm to select articles to post on front page, recommend? I guess implying they will get read more or shared more, and not purely investors' behavior.
So when I go, the default is you sort by latest, right? So the most recent article appears at the top. So it's, in that sense, there's no bias there, at least from my understanding. It is true that some articles they get chosen by editors, like they receive this editor's pick tag, so then they get a little bit of extra attention, of course. But I'm not aware of like an algorithm that tries to sort these. It's more time stamped. Now, of course, at some point you can then say, oh, there's this author that composed this really interesting article. I want to, anytime this author posts an article, I want to follow that. So you can kind of sign yourself up. So every time that author posts something, you read it. And there's also that way you can read these articles. But again, there too, there's no algorithm really.
All right. Okay, thanks again. And now let's turn over to Diego for the discussion. So 15 minutes, give or take. The screen is yours.
All right. So it's a real pleasure to read Byoung-Hyoun's paper on listening on investors' thoughts and conversations. So actually looking at my starting slide is so similar to Byoung-Hyoun's pitch that I'm gonna basically skip it. Our Econ 101 models does not take social interactions very seriously, but we know that it matters a lot. There's a huge literature on keeping up with the Jonases. This is Sterling paradox, and there's a study that Koval and Moscovici have done, Veronica Poole et al. And I just want to highlight, so when I finished grad school in 2000, there was no Facebook, there was no Twitter, there was nothing. You know, the way we actually dealt with social interactions was trying to actually get the home address of these different fund managers or analysts or what have you. And there's still a large literature on that. Here now, we actually have this phenomenal data set from Seeking Alpha that tells you exactly the consumption of news by people clicking through this website and the sharing of the news. So as a disclaimer, and you'll see it in my slides, I do virtually zero social media, so I struggle a little bit about what's the difference between Facebook, Seeking Alpha, and Twitter. They all seem blurry to me, so take that into consideration when you hear my comments. Now, I do know Seeking Alpha is a big deal. As a matter of fact, I've done myself some research with their data. Seeking Alpha, just to give a little bit of history, if you think about the data Byoung has, is from 2013. It was pretty easy to crawl back then. Nowadays, it's much more challenging to actually get data from them. Seeking Alpha has all kinds of really cool stuff. It has the articles that Byoung is studying this paper. There's also earning calls with the audio and the transcripts and many other cool things. So kudos to the authors for looking into Seeking Alpha, given that it is an important social platform. So what are the main empirical findings? I would say is basically two pieces. One is understanding how we consume articles versus how we shared these articles. And I'll give you a take on this consumption part, which I find fascinating, and is this idea that we seem to consume more negative news. This echoes really well within the literature in general. And the real interesting finding, I think, this paper, this idea that they're sharing completely different news than the ones they're consuming. And to be honest, I haven't thought about the sharing piece that much. I consider a little bit second order to the consumption piece, even though it is really, really interesting. And then they have some results on predictability. Essentially, they're showing that they don't share the really good stuff. And then there's this part of potential reversal after there is some buying pressure when you're starting to get too many shares. Although some of these results, as Byoung actually mentioned, you got to take them with a little bit of a grain of salt. It's only 8 months, so the time series on this empirical setting is pretty short. So this predictability stuff is always going to be challenging to find. So here's literature on this about socializing. I mentioned here viruses. There's a reason we're doing this via Zoom instead of doing it in Sweden. There's two papers that I would say are actually quite related. I'm going to get back to this echo chambers paper just because I saw Tony presented literally 10 days ago, which is very related in the sense that they're also looking at retweets, I guess, how you're sharing these stock tweets. And I'm a little confused about the results, but at the end of the day, I don't quite understand. They seem to be very different animals, this idea of stock tweets versus the articles that you're consuming in Seeking Alpha. Seeking Alpha, I almost view it as a Wall Street Journal. Some of these articles are pretty detailed and competently written, whereas stock tweets are mostly, I like Amazon or something like that. And then there's also, I want to highlight this paper by Umar that has a similar results, I think, in terms of this idea of consuming more negative content. And there's a bunch of now new papers using the logs from Edgar, their public information, and people who have managed to actually look at Bloomberg, and you can see the users and exactly what they're consuming and what they're sharing and so on and so forth. So very topical, I would say, the content on this paper. Super fun paper to read. I encourage everybody to take a quick look. It's pretty well documented and easy to follow along. So I don't really have too many comments. I'm going to just give you a quick summary of what was sort of my impression of the paper. I'm going to ask about the econometric specification. I was a little bit puzzled about some of the things. And I think when I was listening to the talk, I may have been confused about exactly how they're running it. But this will be a very easy fix. So I'll just highlight what I want to say there. And then some thoughts on the empirical exercise itself. What are we measuring here with this Seeking Alpha news consumption, if you wish. Now, let me give you my own story on this topic, because it's something I've been thinking about for 10 years. So I've been working on news by and large, mostly print news, also now some TV and other things. And there, the data sets that you get is you get the text from the Wall Street Journal, the New York Times, and then you can see how the market is moving up and down. But you don't get to see people demanding this news. And now it's a fact that the Wall Street Journal and the New York Times, in the apps, they actually do have the click-through data. So I actually remember when I was in Carolina contacting an alum that was working at the Wall Street Journal and begging, and nothing came out of it. So it was really, really sad. But now there's other papers that come out since that seem to be getting there. And I think this paper has data that is very, very close to what I wanted. Because essentially, when these guys log into Seeking Alpha, they get a set of news out in front of them, and one gets to observe which ones they actually pick and decide to read and then to share. And to give you a little bit of what is my own prior on news consumption in general, is this idea of catering to investors' beliefs. And there is a huge literature in economics. Ken and Shapiro are probably the biggest proponents of this idea that people consume the news that they want to hear. And this is why we have, such a dichotomy in US politics, for example. People watch Fox News, so they only listen to the pro-Trump narrative. They don't go back and read the New York Times and vice versa. Now, I've been thinking about this for a long time, this idea of catering to investors' beliefs in the context of investment decisions, and it's a lot more nuanced. What is it that readers really want to hear? Do they really want to read negative news? I mean, if they're too long on average, which I think the average investor has to be long, that seems to be a little bit masochistic to be reading the bad stuff. But it appears that that's the case. So we unfortunately don't have good theory models to help us get around these type of questions. But I wanted to at least sort of give you a little bit of bigger context on what this paper is trying to get to. So what is the corpora? The authors had the server log data from Seeking Alpha. And you mentioned this is bigger than CNBC, bigger than weather.com. The weather.com, I'm with you. That's really shocking. And I got to say that, how do you get server log data from Seeking Alpha? That's like amazing. Now, the drawback is, of course, they only have 8 months, which is a little bit of a, unfortunate. They're also not the most exciting months. It's 2012 and 2013. They were pretty quiet months, but nonetheless, really fascinating. Over 20,000 single stock opinion articles. And this is important, that the corpora here, we're talking about essentially individual companies. This is not general market sentiment type of stuff. This is about Facebook or Tesla. Opinion pieces, priceless in my mind, what these authors have put together in terms of a data set. Lots of nuances on the data, and they often describe all these things. So some of these writers actually disclose their long and short positions. Their incentives are likely going to be different than the rest of the people, or the consumption of such news. Then they have tags about whether these articles are actionable, convincing, well presented. I wear a little bit of power when you start doing many of these cross-sectional cuts, but I think are very interesting. This idea of boldness as well. The numbers measure is actually really neat in this context, and I've tried it myself when looking at Wall Street Journal articles, and there I didn't have much bite. I think with this corporate, it does have a lot of bite, because these guys are like giving you the cash flow statements and why they think this stock may be overvalued or undervalued. The paper further has stuff on these 172 anomalies, maybe it's 200 now, the editor's picks, analysts, news media. At some point when I was reading yesterday through it, it's like, okay, I can't keep all this stuff in my head, too many moving parts for a simple man like me. But at the end of the day, the paper is pretty easy. You're gonna have 3 dependent variables, page views, which they call cursory reading, just browse through the article. Then you have, when you read all the way till the end, that's what I would call an actual reading. And then articles shares with others. And since I don't understand what motivates that, I'm going to call that fun times. Why would actually somebody just, send mail on a story? Now, here's the basic specification that the authors run. And essentially, they just changed the Y variable in these 3 specification view, and they did a very clear job explaining it. So we have the read, retweet, or share as a bunch of all these features that I highlighted a second ago. And my only comment here is that I got a little bit confused between, I would like to see some ITs and Js, and I would be the person consuming it, T would be the date, and J would be the company. And the authors are aggregating in some way that I still could not get my head around, even after the presentation. And this matters because in the empirical design, you may want to put in some fixed effects to suck up some of the variation. We are all very different. There are some people who compulsively read the New York Times. I would be one of those. And the Wall Street Journal, there's many people that just browse through a front page for 2 minutes and move on. So it seems like some of these fixed effects will have some bite in this context, and they might help the authors tease out some of the alternative hypotheses that they were discussing. So at the very least, I think you should make a little bit clear exactly how they're running these different specifications. It's a very easy job. I just want to close by a couple of thoughts on what are we thinking with these Seeking Alpha users? What is the objective function? Right? So the authors write, if being liked and viewed favorable by their peers is an important consideration to investors, investors may refrain from disseminating content that is of more negative nature. Now, the peers, what is the peers in this context? This is not the people that I go have my beer, my happy hour on Fridays, right? These are guys that interact on the internet. You know, many hundreds of people potentially could actually get some of these comments that I make. So I'm not quite sure, is this really a first order consideration? You know, if I think about maybe career or glowing concerns, trying to look smart with my peers, maybe, you know, part of the objective function. And I couldn't refrain to actually put in, this is a very typical punchline from journalists when they think about negative news versus positive news. And it's this idea that if it bleeds, it leads. Meaning negative news sell, positive news really don't sell. And this seems, my take on this, that is probably human nature, and it may be part of what explains some of the results in terms of consumption in the paper. I have a bunch of other small comments, but in the benefit of time, to be able to allow for questions, let me just give you my closing remarks. Fantastic peek into Seeking Alpha's customer base, thinking about this news consumption and news sharing. I would like to see things repackaged a little bit in the paper. It was a bit mingled. This virality variable that Byoung-Hyoun actually discussed is only introduced at the end when they do the predictability stuff. And I think this dichotomy of consume versus share is probably the most interesting. I think trying to understand why there is this big difference in the content that one consumes versus the content that one shares. I think that's where this paper may actually allow us to move the needle a little bit. Happy to discuss further offline with you. And the last comment would be the relationship to the literature is something you guys may want to think a little bit as well, and in particular this echo chambers paper that seems to be fairly related.
Okay, thanks a lot, Diego. So, Byoung, would you like to pick on any of the comments briefly?
Yeah, no, thanks so much. Yeah, because it's still rather preliminary, so these comments are extremely helpful. Like just like a couple, like I'm not going to respond to every single one. How do we get the data? Yeah, like we had this an earlier paper on where we tried to gauge how useful Seeking Alpha articles are in general. And the referee asked us to do certain things that required server log data. And so we just thought we'd give it a shot. And I remember still, I actually went to their office a few times, just basically, yeah, begging for that data. And they said, this was all pre-Facebook Cambridge Analytica, right? So back then it was still pretty chill. So it was like, if you do a little bit of consulting for us, because there's some things we want to understand about what types of articles our user like and stuff, and then we'll just give you the data. So yeah, so I was pretty lucky. So that I don't think that's possible anymore, because right now people are really, really, really reluctant to share any sorts of data. The articles the regressions are done at the article level. I should have made that much clearer. So we could include author fixed effects, date fixed effects, firm fixed effects, consumer fixed effects we can't do because all the data is aggregated at the article level. So we've actually tried author and firm fixed effects. The results were pretty similar. And then, yeah, everything else. Yeah, I guess with peers, it's more like, so when I share an article, so my thinking is that I might actually share it even to, if I see a cool article, I might share it actually to Diego, right? Or Tony, or like here down the road, Justin Murphy, and like I might just send him an email. Because I mean, so I think most of the times you actually share it with people in your actual physical human network, because you need to punch in their email address. And so it's different from Twitter, where you just click like liked or something, and then it gets shared to all your followers. You have to punch in the email address. So it makes it more likely that this is actually a person you actually personally know in real life. Yeah. No, but thanks so much. Like, this is actually really helpful. I'd love to have the slides.
Well, there's not even going to be the recording, right? So.
Oh yeah, that's right. That's right. Different world.
All right.
Happy to send the slides over to you.
Yeah. Thanks, Diego.
Independently. Great. So there's still time for questions. We actually have 2 questions waiting in the pipeline. So one was from Anton. So maybe you'd like to, Anton Hasselgren, maybe you'd like to ask it yourself directly.
Sure. Hi, Anton from Stockholm University.
Hi.
So I'm just curious, and maybe this is data-driven, but the first part of the question is why are you using email shares specifically and not like LinkedIn shares and Facebook shares? And what do you think the difference would be in terms of the results and the sharing behavior if you use those kind of shares?
So we only have data on email shares. So back in 2012, so Facebook started, I think, 2009, 2010. And so 2012, I'm actually not even sure you could share through Facebook. I should actually double check on that. Maybe that, so we I think there's a chance they couldn't even share through LinkedIn and Facebook. Email was the only option. That's why we only have data on emails, or maybe they could share through Facebook. But either way, we only have data on emails. I think the difference is a little bit what Diego alluded to, right? So if I do Facebook share, I could share it with like anybody in my Facebook network, which that's a lot of people that I don't actually really know necessarily, right? So it's a little bit more anonymous crowd in a way. And I guess it gets shared to everyone in your Facebook network versus email is a little bit more targeted, right? Because you share it with only the people you then actually punch in. So it's more targeted as opposed to like everybody in my Facebook network. And I think it's more likely that you actually personally know these people, right? For you to punch in their actual email address. So I think that's the key difference there. I think either one would be interesting to study. We only look at the emails because of data.
I understand, thanks.
Sure.
Just an addition there as well.
Yeah.
That thinking about how these types of shares can be different will also be relate to potentially different results from like the Twitter literature or...
That's absolutely correct. Yeah, I think that's a key difference also that, yeah, we need to flesh out. We just need to discuss the Twitter literature more, or I don't think we discuss it at all. We need to discuss that literature and highlight some of the differences. Yeah.
All right. Thanks for the answer.
Thanks, Anton.
Okay, so that actually, the other question we had sounds a bit related actually. It was from a user who only identifies themselves as Y. Did your question get answered actually? Because it was about, have you considered page views and sharing only on social media platforms? I guess that's...
Yeah, that would be nice. But we don't have that data, unfortunately.
Yeah, fair enough.
Yeah.
So if you have more questions, then just raise your hands in the Zoom app. And meanwhile, I'll start a quick poll about today's webinar. It's just a few questions, 5 questions that you can answer in between.
Oh, that's cool.
Yeah.
How does this?
It went out to everyone. So, but yeah.
Oh, I see.
Are there any more questions for our speaker?
Yeah. I mean, it's. I am actually also. I would like, particularly with like a little bit what Diego was saying. We do lack economic theories as to what types of content are we personally more likely to consume versus more likely to share. We lack a lot. We lack guidance in that regard. There's a little bit of stuff in the psychology literature, but I do find that, like, particularly with what's going on with the virus right now, I do find a little bit, and maybe that's just, again, like a confirmation bias in my head. Like when I see stuff about like bad stuff, I actually am I read all of them, but I don't forward them to my friends because I feel like they're kind of in a different state, right? I don't want to break them. Like some of them might be a little bit fragile right now, so I don't want to share it. So I don't know. It seems kind of natural to me, but yeah, it would be nice to actually have some theory of why we behave that way. So if anyone out there knows of a good paper or a book even that I could learn more about this, that would be super helpful.
There is only one paper I can think of dealing with a theory of financial media. Is by Eitan Goldman and co-authors. It's in the Israel conference that is coming up in a couple of weeks.
Oh, cool.
So if you want to take a look, and that's the only one that I can think of specific in finance. Mulanathan and Schleifer and these guys have other stuff in sort of media and economics, but that's mostly political slant rather than financial news.
Yeah.
So one thing that I was wondering, like, what are the kind of incentives for authors on seeking alpha? Because you said on one hand they actually get paid.
Yeah.
But how is that actually calculated? So that they get paid for more views or for shares as well, or
page views. Recently they added a few more elements, like if you cover certain types of stocks, you're more likely to get something. They did that to encourage coverage of small cap stocks.
Mm-hmm.
But by and large, it's page view. So I forget actually the exact conversion ratio, but like for X amount of page views, you get X dollars. So your goal would be to kind of build a following, so that more and more people, just anytime you put out an article, so anytime Diego puts out an article on his website, people just naturally read it because like he's built a certain reputation and following. So I think Seeking Alpha authors want to do something similar.
So then, in a way, they would be incentivized to write negative articles if we sort of follow your results, or?
Yeah, that is actually an interesting implication. Yeah, I don't know whether they know that that's actually the types of articles that are more likely to get viewed, but yeah, that would be an implication. Yeah, that's true.
Yeah.
Oh, thanks, Gustavo, for the paper.
Okay,
Cool.
getting some.
Yeah. Okay.
Getting something positive shared.
Yeah, no, I'm getting messages.
Cool.
Cool. Thank you.
Okay. Any final questions from the audience? All right, then thank you very much, Hwang, for the presentation, Diego for the discussion.
Thanks.
Our next webinar is in 2 weeks, and the same two gentlemen will actually trade places. But the topic is going to be equally good, I'm sure. So stay tuned, and meanwhile, hope to see you at the conference next week.
Sounds good.
Waking there
Cool.
too.
Bye, Diego. Thank you so much.
Take care, everyone.
Thank you, Mikael.
Thank you. Later.
Thank you. Bye.
Yeah, bye, Roxana.
Bye. See ya.